Like most people out there, when I first started investing, I had no clue what was going on, and I was simply impatient to get started because the sooner I would start, the sooner I would become financially independent. And of course, this mindset led to me simply throwing some money out the window by buying high and selling low, which, by the way, is not what you need to do. But then I started doing some research. I started learning more and more about investing. And something that really caught my attention, but also took me a while to understand, was dividends. Hello everyone, this is Curiousist, and today we're going to talk about dividends. When a company is profitable, they have the choice to either reinvest the profits back into the company or to contribute these profits to the shareholders in the form of dividends. A dividend is a payment shareholders receive from a company's earnings. Now, in order to make this simple and visual, let me use an example. Say we have Apple. Apple's price is at $172.39 per share. When you buy a share of Apple, essentially you buy a piece of that company. What a dividend payment is Apple thanking you for holding stock. Now, how much is this payment going to be? Well, this is public information, and you can view it before buying any stocks. Every company has its own what's called dividend yield. A dividend yield tells you the percentage of a company's share price that it pays in dividends each year. For Apple, for example, right now, it's at 0.51% per share, which translates to about $0.88 for one share. And since Apple pays you every quarter, you'll be getting $0.22 every 3 months, every quarter. So this is it. Apple pays you for holding on to the stock, for being one of their investors. Now, this might not seem like a lot, but keep in mind that this will accumulate as you buy more shares and if your dividends are reinvested and if the stock increases. It's important to understand that the dividend strategy is not a get-rich-quick way. It's more of a long-term wealth generation. Now, other than Apple, there's other companies that have higher dividend yields, meaning that they pay more per share. Coca-Cola, for example, has a 2.76% dividend yield, and others, such as AT&T, have a yield of 8.64%. However, you always have to be careful of companies with very high dividend yields because they tend to be a bit riskier, a bit unstable. Just, you have to do your research before buying any stock. Companies are not forced to pay any dividends, and they can increase them, they can reduce them, or even stop them at any time. Another important thing to note is that in order to be eligible to receive the dividend, you need to hold the company stock sometime before the dividend date. Now, this varies from company to company, but it's typically 1 to 6 weeks. The last day that would make you eligible to receive a dividend is the day before what's called the ex-dividend date. If you purchase a stock on its ex-dividend date or after, unfortunately, you will not receive the next payment. So there you have it, a quick and easy guide on dividends. If you found that video helpful, make sure you subscribe and turn on the notifications not only to be notified when we post another video, but also to be notified when we go live and analyze the markets together. Thank you very much for watching, and remember, stay curious.